Hi everyone, and welcome to this video. Where we will be discussing QYLD ETF. It's a global ex Nasdaq 100 covered call ETF. It is quite popular with dividend investors, people who are seeking income. This ETF pays a monthly dividend, so it's even more attractive, and it has a crazy dividend yield above 10%. So we will look at the advantages of owning this kind of ETF and the disadvantages. So what QYLD is a passive index ETF. However, it uses a covered call strategy. Just quickly, what a covered call strategy means is that the ETF manager will hold the constituents of the Nasdaq 100, so the largest 100 tech companies that are listed on the Nasdaq. But at the same time, they will issue call options to protect the portfolio from sudden drops. And so usually with QYLD, you will, if we compare you to someone who's holding the index itself, like QQQ, Nasdaq 100. So if you're holding that ETF versus holding QYLD, QYLD will be less volatile and will offer you a much higher dividend yield because of the call option strategy. However, when the market is advancing, when the market is good, when the returns are there, the performance is there, you will have a better performance if you hold the index itself versus holding QYLD, because QYLD, since it's a covered call strategy, it's kind of letting go of the potential of the stocks and preferring to be more conservative. So with the covered call strategy, you're more conservative. You don't want the future potential growth of these stocks. You just want to protect your portfolio and collect premiums to increase the dividend yield. So that's basically the main disadvantage of QYLD, is that you're letting go of the growth potential of the stocks that are part of the Nasdaq 100. You're preferring just to collect option premiums and have a very decent growth versus what someone who will be holding the Nasdaq 100 directly. So as I mentioned here, so it protects you against downside risk, but not 100%. Also, when you write a covered call, you give up on some of the stock's potential gains, because essentially it's a very conservative strategy. Now the positives: you have an attractive yield thanks to the money earned issuing call options, and since the market has been volatile, QYLD managers were able to have a dividend yield up to 10%, 11%, depending on the price of QYLD. So it's quite an attractive dividend yield. You have a lower volatility than investing in the Nasdaq 100 ETF, and it suits conservative investors who are focused solely on income. High volatility increases the premiums, because when we talk about volatility, like let's say if a stock is trading at $100, but in 1 month or 2 months, investors are expecting +5 or -5%, so it's not really volatile. So the option premium will be really low because you're playing on the range is really narrow. However, when we talk about tech stocks, especially right now where the market is kind of nervous, the volatility is just crazy. So in 2 months, it could be plus 25% or less 25%. So because of this volatility, and the range is such a high range, you can issue call options and the premium will be high. So this is why the QYLD has done really well, because volatility increases option premiums, thus increases the dividend yield. So that's for the advantages. However, we will go through these two graphs which kind of show the advantages. Here you have the QYLD, which is in blue, and you have QQQ, which is a pure index ETF. So you're just investing in the Nasdaq 100, no covered call, just you're on the Nasdaq 100. You notice here volatility is lower with QYLD, whereas the Nasdaq 100, the volatility is much high. You still have volatility, right? You still have volatility there. It's just it's lower, so less risk for you. The second here is for 6 months. Um, we will see here in bear markets. So when the stocks are falling, you are falling less than the Nasdaq 100. The Nasdaq 100 fell by 18.79%, whereas QYLD fell only by 47%. But keep in mind, if the market goes up, the person who holds Nasdaq 100 will have a much, much, much better performance than someone holding QYLD. So this is just in bear markets. Now the negatives of owning QYLD. You have the poor performance. Like if you invest in the Nasdaq 100 in the long term, you're gonna beat the QYLD performance, because QYLD with the covered call strategy, they are giving up on the upside potential of the stocks. They are just issuing options to protect against volatility or the unknown what will happen to that stock. So they are protecting themselves. So in bear markets, they will issue options at an attractive price for investors who are more aggressive. And when the markets are up, they will say, I don't want plus 20%, I just want plus 5%. So I will issue an option based on that. And they will find an investor who is much more optimistic, and they will buy the option because it's profitable for them. So you will get a poor performance because you're giving up on the upside potential. You're more income oriented. The strategy of covered call can be risky, especially when the market is unpredictable. Like you need a buyer and a seller for an option. So if the market is unpredictable, the option premium becomes really low. And also, if there is no volatility, like low volatility, the option premium will shrink. So the dividend yield is not safe with QYLD and is not fixed. Now it's 11%. 6 months from now, it will be completely a different dividend yield. So keep that in mind. Don't buy an ETF just because the dividend yield is in the roof. Focus on, try to understand the strategy here. The dividend yield of the Nasdaq 100 is less than 1%. So what QYLD is giving you is 10%. So 9% is variable. It's basically just the options that they are issuing. And the options are not like they change every month. So it's not something that you could rely on. QYLD is not diversified. Obviously, you're investing only in tech firms since we're talking about the Nasdaq 100. So it's not a diversified investment. I think this one is obvious, like since we're talking about Nasdaq 100. There is also the fee, of course, 0.6% total expense ratio that you have to take in consideration. Whenever you're buying an ETF, there is always a fee, and usually the fees they can be quite high. 0.6% compared to QQQ, which is a passive index, Nasdaq 100. There's a huge difference. Like usually index ETFs don't even exceed 0.1%. But here, because of the covered call strategy, they are charging you 0.6%, which can be considered as high. Now I'm comparing here the performance between QYLD. So if you own QYLD versus someone who owns the Nasdaq 100, you'll see here in good years, in 5 years range, with QQQ, you have a 20% annual average return versus only 9% with QYLD. 3 years, the same thing, but it still shows you that QYLD is still profitable. It has a decent performance for the volatility because it's lower volatility, so we expect less return than owning something like QQQ, which is like the same volatility as the index. So it's still a good fund. Here it's the total return, so it's including dividends. As you can see, like it's a decent performance. The dividend yield is more than attractive, 11.80%, but still it's not sustainable. It's all based on premiums, which are variable by their nature. It's not something fixed. You will see here the dividend for QQQ is only 0.55%. So it's ideal for someone who's just focused on income and does not want the volatility of the index, especially right now where the markets are. No one knows where they are headed, basically, because we're still waiting for the central bank. We're still waiting for so many unknowns regarding the situation in Ukraine and so on and so forth. So all that plays in the volatility and benefits QYLD in terms of dividend yield. So we covered here all the risks that mentioned. The main one, if you are an income seeker, is that the options by nature are volatile and their value depend greatly on market sentiment. So don't expect 11% dividend yield to stay in 6 months or 1 year. It will definitely go lower. It's a monthly dividend, so it's great for someone who's looking for a monthly income. For the holdings, they have the same holding as the Nasdaq-100. So you have Apple, Microsoft, Amazon, Tesla, you name them. And with these holdings, they will issue call options on these stocks. So this is why it's called covered call, because they own the stocks. It's not a naked call, so it's covered call, so they own the stock. So I hope this video helped you kind of clarify if you should be on the QYLD team and buy this ETF. If you have any questions or comments, please leave them. I will also post the link to this article. It has more details. And if you want to check also the other posts that I have, thank you very much and have a great day.